So with September just passed, looking at the market, we've seen quite a big shakeup. Now historically speaking, on average, September and October market usually perform poorly, hence there is the term September and October effect. However, for this year, it's especially bad. For the US market, it is one of the worst September in a decade. Dow Jones, S&P 500, and Nasdaq have dropped at least 3.5% in the last month. Although the market has bounced back slightly, everyone is still quite nervous. So what I want to do in this video is take some time and go into some major events that could bring even more volatility to the market in October. So if you're investing currently and that's something you're interested in, keep watching this video. Now without further ado, let's get started. So first, let's give a very quick overview of what happened in September, because some of these things could carry forward into October as well. Now for last month, there are two major events that caused volatility to the market. Number one is the Evergrande collapse. Now for this, I'm not going to go into too much here because I've already talked about this in detail on the video right here. So if you haven't already, check out that video on what happened. But basically during September, this has sent a shockwave around the globe and have brought down almost every single indexes. Now after that, slightly positive news has come out. For example, some companies are thinking about taking over part of Evergrande, while the Chinese government is rumored to take over another part. So for now, things seem to be settled down, but that doesn't mean the volatility has gone away. So this is something that we have to look into for October as well. Now the second thing that brought down the market in September was a spike in the bond yield. So this is also something we have made a video on earlier in the year, so if you haven't watched that already, you can check it out right here. But basically, you know that yield, which is the interest rate, and the bond price move in opposite directions. So when bond price goes down, yield goes up and vice versa. Now in this case, why is yield spiking up? Yield is spiking up because bond price is going down. Bond price is going down is because people are dumping bonds. So why are people dumping bonds? Well, usually when people dump bonds, it's in fear of inflation. Now in the previous video right here, I've gone into a very detailed research by Lynn Alden on what is inflation. And in there, she talked about that bond is one of the worst tools we can invest in if there is a spike of inflation, because the inflation is going to eat away the bond interest. So when anytime there's a fear of spike in inflation coming, people usually dump bonds, which drive down the bond price, and which means yield have to go up to attract more investor back in. Now anytime bond yield jumps and spike like this, it will send a panic to the investors in the equity market, because this could also signal that, hey, maybe interest rate is going to increase sooner than we expected. And what that will mean is company, especially those that are focused on growth, which means they borrow a lot of debt, their debt payment could go up, which could affect their future profitability. And following these chain of thoughts, investors will likely panic and massively sell off their stocks. So this is why the market has dropped as well, especially tech stocks, because usually those are the highest growth, which means most debt, and those are the first one to get sold whenever there's a fear of inflation and a spike in the bond yield. Now we have seen something like this in the first half of 2021, so this is not a new thing that we're experiencing, it's just kind of like a second round. So those are the two major events in September. Now let's move forward and talk about the four major events that caught my eyes in October that could bring volatility to the market. Keep in mind that there is a lot more than these four that is going on in the market. Obviously, I can't read into every single article out there. So if you know something or you read something that can help everyone, please let everyone know so we can all benefit from it. Alright, so first let's start with the least impact event, and that is the debt ceiling. Now at the time when I'm writing the notes down, the debt ceiling has not been resolved, so this is why I put it here. But as of recording, it seems like they have reached an agreement to temporarily lift the debt ceiling at least until December. So this is really gonna be very little effect. But anyway, I still want to talk about it because come December, this could come out and be a problem once again. Debt ceiling is basically a limit on what the US government's authority to borrow can be. They cannot borrow infinitely. While it does seem so, they do have some limit, and that's the debt ceiling. Every time they hit the debt ceiling, they have to negotiate within the government, within the Congress, to raise the debt ceiling again. Now this is not new. Raising the debt ceiling basically happens at every single presidency. In the US, they have raised the debt ceiling 94 times and they have lowered it 10 times. So as you can see, there's not something new. They do this all the time. So usually around these times, it's basically a lot of compromises, negotiation, and power struggle for everyone to get a little bit of what they want so they can pass the bill. And likely before we actually hit the debt ceiling deadline, the bill will be passed, debt ceiling will be raised once again. It's only going to be an issue if we actually hit the debt ceiling. When that happens, that means the US government have exhausted their authority to borrow, so they will have to go into the reserve, and if the reserve ever runs out, not only the whole US government will have to be shut down because salary can no longer be paid, social securities will also stop. On top of that, that means US can no longer meet its debt bond payments, which likely means US will have to default, and obviously this is going to be a bad news for everyone around the globe. Now, even though there are extreme measures that the president can take to force a raise in the debt ceiling, this is a very long and tedious process. We have actually faced one such crisis during 2011 when Obama was the president. Now, just before this actually turned into a worldwide crisis, they were able to reach a compromise and pass the bill. However, during this time, market has seen one of the most volatile week. Now, as I said before, the parties have reached an agreement to temporarily raise the debt ceiling at least until December. So for October, this should not be a problem, but in the future, that's definitely something we want to keep an eye on, because while every time so far the debt ceiling has passed before the deadline, this could be a black swan event where people get a little bit too confident on, and that's what triggered the next financial crisis. So that's something we need to pay attention on and keep in mind every time the debt ceiling topic comes up. Now next, let's move on to another major event, and that's the Evergrande collapse that happened before and its ripple effect. So I've talked about this in my previous video, but Evergrande collapse itself should not be too much of a problem. Even though it will send some shockwave and negative news to the market, it should not be something that trigger a massive sell-off and a massive crash. And there are two major reasons. Number one is that Evergrande, being a real estate developer, has one of the most valuable assets on hand, which are lands, so they can use that to sell off to negotiate for a better deal. Now, second of all, while it is massive, the foreign debt itself, just by Evergrande, is not enough to put a huge dent to the global market. So that's why I think Evergrande itself is not going to cause a crash. However, its complex structure and connection to many other companies and its potential ripple effect is something we need to pay attention to. Now, Chinese real estate sector has a total outstanding cross-border bonds of $232 billion, with more than 70% of the sector's bonds being rated as high yield notes by Fitch. Evergrande's collapse squeezes the funding cost for high-yield company sector for the whole Asia. Several days ago, another real estate company called Fantasia has failed to repay $205 million in remaining principal of the bonds. All rating agencies have downgraded this company to near default. Now, online article attributed Fantasia's cash crunch to the 3 red line policy implemented by the Chinese government, which we have talked about in this video right here. But basically, it's 3 ratio that all real estate developers have to keep if they still want to continue to borrow. This 3 red line policy is also what puts Evergrande into a massive cash crunch that forced them to sell their condo on hand at a massive discount. So first we have Evergrande, then we have Fantasia. While Fantasia is a lot smaller than Evergrande, this really begs the question if this is just a signal and the beginning of what is about to happen, a chain collapse, or the collapse is just going to stop with these 2 companies. So this is why we need to pay attention to the story's development moving forward. Now next, let's talk about another issue, which is the power supply issue going on in China and other countries. Near the end of September, there has been report coming out saying that China is basically cutting electricity for certain things. For example, workers have to shift their work hours to night shift. When everyone's sleeping, that's when they can turn on the factory to work, because power usage is not going to be enough if everybody uses power during the day. And also there are other things like first 3 floors, you cannot use the elevator, you should take the stairs to conserve power. Things like these have come out from online articles. Now, this is not a first time thing. Power usage problem has been common in China, especially during peak usage in winter or summer when everybody has to turn on AC or everybody has to turn on their heater. But this year, it seems like it has been more serious than usual. The state-run Global Time newspaper said there has been outage in 4 provinces: Guangdong in the south, Heilongjiang, Jilin, and Naoling in the northeast. There's also power cut in other parts of the country as well. Now, on top of that, for past couple of days, major regions Shaanxi have been experiencing a tremendous amount of rainfall. There has been flood everywhere, and 25 plus coal mine has to be shut down, which further adds to the power supply problem. So why does it matter and may cause volatility to the global market? Well, that's because it affects China's production. Official figures shown in September 2021, Chinese factory activities shrunk to its lowest since February 2020 when the country was locked down during COVID-19. Goldman Sachs estimated that 44% of country's industrial activities is affected by this power outage. It's now expected that China's GDP will drop from 8.2% to 7.8%. Now, we're not sure how long this problem can be, but if it's prolonged enough, this could really affect its output. So what that would mean is a potential trigger for panic about inflation once again. And as we have spoke about earlier in the video, when there's a panic about inflation, people dump bonds, bond yield goes up, people panic about equities, they sell off equities. So this is why we have to pay attention to this event. Now, power supply issue is not only privy to China, other parts of the world is also experiencing similar things. For example, the UK, as you probably have read about, they have a massive gas station problem running out of fuels. Energy bill is also jumping massively across Europe. And also the soaring in oil, coal, and gas price. However, one thing to keep in mind is while they all seem to happen simultaneously, they're likely not connected. Each event is happening with a different reason. For example, in UK, the fuel problem is more about not enough truck drivers delivering resources to the country, which is a very different reason compared to other countries facing the same power issue. So last event we need to pay attention to is potentially a second trade war. Now, as we all know, during Trump's presidency, the country has implemented a lot of tariffs all around the world, but especially is targeting towards China. Now, while the intention is to make the other country pay for all these tariffs, the reality is that with these tariffs in place, US citizens and companies are the ones that are footing the bill. New York Federal Reserve estimated that the total bill is around $106 billion for the US, which translates to $831 per household per year as long as these tariffs are in place. Now, many people expected that once Biden has come into power, all these trade war, all these tariffs will be gone very soon. But this week, their unraveling in the report has shown little changes to what Trump and its administration have implemented. US Trade Rep Catherine Tai said that while the tariffs are blunt instruments, it is the only tool they have that is effective against China. So they will remain in place, but with some twists. They will implement a targeted tariff exclusion process to ensure they are serving America's best interests. So on common things that is going to affect every single household for things like commodity or basic ingredients, they're likely going to have an exclusion for those to not get hit with a tariff, so then people don't have to pay extra for the basic items. Now in there, they will also say that they will not pursue a phase 2 of a trade war, but they will discuss phase 1 performance with China because there has been some promises not fulfilled yet. Article says Biden wants to subsidize specific industry like the semiconductor within the US. As we have saw already, plans have been announced to fund the construction of chip production factories in Arizona and other places. So they have announced these already and it's underway. I'm guessing they want to do even more on this, and also they have said that they want to maintain sanctions like the ones on Huawei and ZTE. So it seems like the US is shifting the direction and the tactic against China, and they've said it already, tariffs is harmful to US itself and it's not something sustainable that they can keep going forever. So this is why they're announcing all these changes right now. But anytime there are changes, there is going to bring uncertainty and volatility to the market, especially if they first announce good news and then later they retract back and they say, well, we're going to do other thing instead. This is definitely going to send shockwave to the market. So this is why we also have to pay attention to what is going on with the trade war currently. So those are the 4 items that personally I would pay more attention to see how they develop. Now, what can we do with our investment if there are so much uncertainty? My advice is going to be the same every time there is volatility in the market. Number 1 is to stay invested. You don't want to think about all the what ifs, have it all in cash just to miss out all the potential gains every day that as market is still going on. But if you're going to be invested, then you also need a plan in general to handle different scenarios. Now, in my personal experience, one of the best things you can do to make sure you're not nervous about the current uncertain and volatile market is to dollar cost average into your portfolio. So instead of buying lump sum, basically you want to chop up your buy-in into small pieces and do it periodically regardless if the market goes up or down. This is a very simple and effective way to take away the emotional part of investing and just keep buying in periodically. On top of that, you might also want to have some rules or some plan in place. If market really have a huge drop in a day or in a week, then you should know what kind of adjustment you want to make to rebalance your portfolio to have a better performance moving forward. Now, if you like everything I've been saying today, hit the like button once. If you don't like what I'm saying, hit the dislike button twice. Next one I want to hear from you is what you're doing with your portfolio, what are some things you're watching out for, and what do you think will happen in October? Let me know in the comment down below. And if you like these kind of videos, make sure you like and subscribe to the channel, click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!